There's been a great deal of conversation recently about the need to close tax loopholes. This is a welcome development for those of us who've gone after these loopholes for years. It is particularly timely as the public is focusing more and more on how tax loopholes distort economic incentives and often benefit the wealthiest among us at the expense of most U.S. taxpayers. Last week, President Obama released a framework for business tax reform that took aim at many corporate tax loopholes. And I look forward to working with the administration and with our colleagues in the Senate to make real reform a reality. Reform that brings greater fairness to the tax code, eliminates incentives for moving jobs and assets overseas, restores revenue lost to unjustified tax loopholes, and helps us reduce the deficit without damaging vital programs for education, transportation, health care, and national security. Now, one recent and very public announcement illustrates dramatically our tax code's distortions and the need for reform. At the center of this story is Facebook and its founder and CEO, Mark Zuckerberg. Mr. Zuckerberg and his company have become a remarkable American business success story. As part of that success, Facebook is in the process of making its initial public offering of stock. The public documents that Facebook is required to file as part of that offering tell another compelling story about one of our tax code's unjustified corporate loopholes. According to its filings, when Facebook goes public, Mr. Zuckerberg plans to exercise options to purchase 120 million shares of stock for 6 cents a share. Mr. Zuckerberg's shares, obviously, are going to be worth a great deal more than 6 cents each, or a total of about $7 million. They will apparently be worth in the neighborhood of $5 billion. Now, here's where the tax loophole comes in. Under current law, Facebook can, perfectly legally, tell investors and the public and regulators that the stock options that he received cost the company a mere 6 cents a share. That's the expense shown on the company's books. But the company can also, perfectly legally, later on file a tax return claiming that those same options cost the company something close to what the shares actually sell for later on, perhaps $40 a share. And the company can take a tax deduction for that far larger amount. So the books show a highly profitable company, profitable in part because of the relatively small expense that the company shows on its books for the stock options that it grants to its employees. But when it comes time to pay taxes, to pay Uncle Sam, the loophole in the tax code allows the company to take a tax deduction for a far larger expense than they've shown on their books. Now, in addition, Facebook is allowed by law to carry back the so-called loss arising from this deduction for 2 years into the past, which means that it can claim a tax refund for the income tax that it has paid over the past 2 years, a refund that the company estimates at $500 million. So instead of paying taxes to the Treasury, this profitable company will claim a hefty refund on the taxes already paid. But that's not all. The company says that it will, is allowed by law, also carry forward the so-called losses arising from this tax deduction for over 20 years into the future, thereby reducing any tax that it owes in the years ahead. Altogether, this loophole could give Facebook a tax break of up to $3 billion. Now, the end result is that a profitable U.S. corporation, a success story, could end up paying no taxes at all for years, even decades. Now, I emphasize that Facebook's actions are within the law. As with so much of our tax code, it's not the law breaking that shocks the conscience. It's the stuff that's perfectly legal. For years, my permanent subcommittee on investigations has identified this stock option loophole and tried to explain its cost, its unfairness, and why it should be closed. Facebook's $3 billion tax break brings the issue into sharp focus. Facebook's use of this loophole is the most pointed illustration yet of the cost of this loophole. It's difficult to get our minds around a $3 billion tax break for a single corporation. Just how big is it? Well, consider this. In 2009, the most recent year for which IRS data is available, taxpayers from 11 states in our union sent less than $3 billion in individual income tax revenue to the Treasury. How does this make any sense? After all, American taxpayers are going to have to make up for what Facebook's tax deduction cost the Treasury. That $3 billion is either going to come out of the pockets of American families now, or it will add to the deficit that they're going to have to pay for later. What could our nation do with the $3 billion that it will lose when Facebook exploits the stock option loophole? We could reduce the federal deficit. We could pay for programs that protect our seniors and our veterans, put cops on the beat or teachers in the classrooms. $3 billion that Facebook will get in tax deductions would more than triple the budget of the Small Business Administration, which seeks to help American entrepreneurs create jobs and grow the economy. $3 billion would pay for the Pentagon's budget for housing our military families for a full 2 years. It would pay the budget of the National Institute of Science and Technology for 4 years. It would more than triple what we plan to spend helping homeless veterans next year. It would pay 6 times over for the 24 Reaper unmanned aerial vehicles that the Air Force plans to buy next year. Now, some are going to argue that Facebook's tax break is offset by the fact that Mr. Zuckerberg himself, as well as the other executives who are receiving stock options, will pay taxes as individuals. As various news reports indicate, Mr. Zuckerberg will face a substantial tax bill on the $5 billion in compensation that he's about to receive, perhaps in the neighborhood of a $2 billion tax bill. But it is unlikely that the individual taxes that Mr. Zuckerberg pays will offset the tax revenues lost to this loophole. What the Treasury receives from Mr. Zuckerberg, on the one hand, it will return and then some to his company with the other hand. We also should remember that Mr. Zuckerberg's financial future is closely tied to that of his company. The value of the options and his retained interest make that clear. To the extent that his corporation benefits, and as I've shown, Facebook will benefit handsomely from the use of this loophole, Mr. Zuckerberg stands to benefit as well. Put simply, some of that big tax bill that he faces right now will come back to him through the corporation that he will still own a huge part of and will control. There is no reason why Facebook and the other corporations who use this tax loophole should continue to receive these windfall tax deductions. Senator Conrad and I, earlier this month, introduced S-2075, the Cut Unjustified Tax Loopholes Act, or Cut Loopholes Act. This bill, similar to the legislation that I've introduced in the past few Congresses, would close this loophole. Under our bill, corporations would no longer be allowed to claim tax deductions for options that are larger than the expense that they report to their shareholders and to people considering buying their stock. It would also subject stock options to the same $1 million cap on deductions for executive compensation that now applies to other forms of compensation. At the same time, and this is important to know, Madam President, our bill would leave unchanged the way the law applies to individuals who receive stock options, and it would leave unchanged incentive stock options that are used often by startup companies. We would not affect that. I've spoken today about one corporate tax loophole, but there are many, many more. The momentum has never been stronger for tax reform that brings more fairness to the tax code, restores revenue lost to unjustified tax loopholes, reduces the deficit, and protects important priorities. And I look forward to working with our colleagues and with the administration to turn that momentum into real reform.